Hello everyone, it's Paul Tilley again. Welcome back to Financial Accounting 1. And today we're looking at Unit 8. And Unit 8 deals with receivables. Receivables, as a general rule, come in two basic categories. Short term, things that are going to come in within 1 year, one accounting cycle. Receivables are called accounts receivable. These will be expected to come in, and generally it is money received from our customers who buy product from us on credit. The second type of receivable that we're talking about here is a short-term note receivable, which is a promissory note that will usually come in within 12 months of its issue and bear interest. Specifically in this unit, we're going to describe accounts receivable and how they occur and how they're recorded. We're going to apply what's called the allowance method to account for uncollectible accounts receivable. We're going to estimate uncollectible accounts receivable using approaches based on sales and accounts receivable. And we're also going to describe and record short-term note receivable and calculate its maturity date and interest. And we're going to calculate accounts receivable turnover and days sales on collected to analyze liquidity. And we're going to explain how receivables can be converted to cash before maturity. So first of all, let's take a look at what accounts receivables are. So they arise from credit sales to customers. So we sell something on credit and the customer is going to pay us cash later on. They're often referred to in the industry as trade receivables. And other receivables would include things like interest receivable, rent receivable, tax refund receivable, these sorts of things. Accounts receivable really arise from credit sales to our customers, and they arise out of the revenue recognition principle, which basically says even though we haven't received any cash for it, we have earned the revenue from the sale of that item. So companies selling on account need to make sure that they maintain a separate account for each customer. So Paul Tilley would have his own account at the store and you would have your own account at the store. Accounting standards also recognize the fact that we need to recognize bad debts. So if we make a sale on credit in a given year, we need to recognize that some of those bills will never get paid. So we need to account for bad debt as well. To illustrate how we record accounts receivable, let's just look at this example of Techcom. So Techcom has the following accounts receivable balances at June 30th. So we're looking at our statements as of June 30th. And we see on the left-hand side in the green, our general ledger will show that we have a balance in accounts receivable of $3,000. It's not broken out, there's no detail on that, but we can go look to our receivable subledger, which is a detail of every single account, your account, my account, these sorts of things. And we'll see that it shows RDA Electronics owes us $1,000 and Comp Store owes us $2,000. 2,000 plus 1,000 is 3,000. This is where we can see the match-up between the specifics of the subledger, who owes us the money, usually it's aged as well, but effectively we can see that these two balances, the sum of all of the subledgers, will equate to the general ledger amount in accounts receivable. Let's take a look specifically at the journal entries that would be required. So for example, on July 15th, let's assume that Comp Store came in and bought $950 worth of gear from us. So we would record a debit of accounts receivable. This is an asset account that's going up. We would debit accounts receivable to Comp Store for $950, and we record sales revenue as a credit for $950. Also on the 15th of July, we would record the fact that those items that we sold to Comp Store would come out of our inventory, and our inventory would go down by the amount. So cost of goods sold is the amount for $630, and the merchandise inventory again would be credited, meaning it went down by $630. So these two entries at the top here reflect the fact that the sale was made and that the inventory amount was reduced accordingly. Let's also assume that on July 15th, another company came in and actually paid their bill to us. So we had RDA Electronics had an outstanding amount owing to us. In other words, they owed us money. So they came in on the 15th of July. They gave us $720 cash, and we reduced the accounts receivable from them that we had recorded by $720. This gives an idea of the accounts receivable entry, the inventory entry, and when cash comes in to cover off the accounts receivable. Offering credit to customers is something that certainly encourages business, but it comes with its share of risks because some customers who are granted credit do not or will not pay as they promised. So the accounts of these customers are called uncollectible accounts or bad debts. And accounting rules state that we have to account for the fact that some of these bills will never get paid. So what do? Well, if we offer credit to our customers, we're inevitably going to run into this problem. So we need to consider how should we handle it. So we're going to look at some of the methods that we can use in order to handle accounting for bad debt. First thing have nothing to do with accounting and more to do with good business, and that is look at some of the credit risk analysis tools that are out there. Things like employing credit using scoring models. Do people who you offer credit to meet a test, a scoring model test, that would say, yeah, they're credit worthy? Use the latest technology to make informed credit granting decisions. And again, the banks and organizations that are involved in the credit business could certainly help provide these sorts of things. Adopt technology to improve collection processes. And this would include like online banking, debit, interact, these sorts of things. And monitor the macroeconomic environment. You know, if things are tough in society, high unemployment, these sorts of things, that's going to indicate that you're going to have more bad debt. If things are really well, you'll probably have less bad debt. So just having a good understanding of where you are in the economic world is important. From an accounting model perspective, there are two basic ways that we can write off or prepare for bad debt. First of all, we have something called the allowance method. And the allowance method is really the one that everyone uses because it satisfies the requirements of generally agreed upon accounting principles. There's another method too called the direct method, which is just really as something goes bad, you write it off. So just to further clarify this, let's take a look at a scenario where someone buys something in year one. So here you see year one in blue. So assume that the item is sold in year one and that the bad debt also occurs in year one. Someone tells us before the end of our accounting year that, hey, I'm not going to pay the bill. So that's basically what we're dealing with here. So the direct method basically says, look, the revenue was planned to be received. It didn't get received. We're going to write it off as a bad debt expense. And that works fine within the current year. The problem occurs when we have a sale occurring close to the end of our year. Let's assume that we're in year one and someone comes in and buys something on credit. Now, we don't know at this point if they're going to pay the bill or not. And really, if we assume that they will, everything is good. But if we assume that no, they won't, odds are the recognition of the fact that they won't occur until the next period. And this is where we run into the problem of the matching principle. The matching principle says we need to match up our revenues from a given year with the expenses of a given year. So if someone weren't to pay this particular bill in this example, we kind of defy the matching rule because we recorded a revenue in year one, yet we're going to write that off in year two. So we need to find a way in accounting to be able to estimate the amount of bad debt in the year that it happened. So what we have is this process of looking at estimating our bad debt. So for example, in this one, we're going to estimate that a certain portion of all of the debts that were taken on in the year as people buy stuff on credit, a certain portion of them won't get paid, and we have to estimate it, and we're going to make that a journal entry at the end of the year to record the fact that a certain amount of bad debt won't get paid. But as a rule, companies will use GAAP processes. So what we're looking at are really two methods that are under the allowance methods. First of all, the percentage of sales method, and second of all, the accounts receivable method. So let's take a look at this allowance method. The allowance method is the one that's commonly used, and effectively it meets the principles of the matching principle, which matches the revenues and the expenses in the year that they occur. Okay? So the matching principle requires that bad debts expense be matched and reported in the same period as the sale that generated the receivable. So if you sell it in the year, you account for a potential bad loss in the year. So the allowance method satisfies the matching principle by recording any estimated bad debt expense connected in the current period sales in the same period the relative revenue was earned. So, in order to record an estimated bad debt expense, adjustments for bad debt are made at the end of the accounting period. So basically you run through your year or your accounting period, and then you record an adjusting journal entry at the end, and that adjustment uses a contra asset account called allowance for doubtful accounts. So in order to do that, let's take a look at an example. So recording estimated bad debt for telecom. The estimated bad debts for telecom is $1,500. Now, we're going to look at how they estimated that in a few minutes. But first of all, let's assume that they estimate that the bad debts is $1,500. So the end of period entry would be bad debt expense, $1,500 debit, allowance for doubtful accounts, $1,500 credit. So an allowance count is used since we do not know which customer accounts will be uncollectible. So we don't have a clue. We're just doing a general account here. So let's assume that an account for Jack Kent, let's say Jack Kent is considered uncollectible. Maybe Jack disappears, Jack dies, these sorts of things. So we're pretty sure that we're going to never get that money. So we're going to what's called write it off. So in order to write it off, we do this journal entry: an allowance for doubtful accounts, $520, which was the amount of the write-off, and accounts receivable credit for Jack Kent, $520. Now remember, when the accounts receivable was set up for Jack Kent, it was debited for $520 for him. Now we're saying he's never going to pay that. So effectively, we're going to draw down our allowance for doubtful accounts that we set up at the end of the period, and we are going to record the fact that Jack's $520 is never coming in, so we're reducing the accounts receivable for him. So note that there's no expense recorded when the account is written off. The estimated bad debt expense was previously recorded at the end of the period there. So in order to get a better idea of what we're dealing with here, I'll put two of the accounts together. So here's the two of the journal entries that we just did in the previous two slides together. Okay, we set up the bad debt expense for $1,500 and allowance for doubtful accounts for $1,500. So that contra account set up now, and that's like a pool that we anticipate that will get drawn down in bad debt. In other words, we're saying we anticipate that $1,500 won't come in. Then the next thing was we found that, well, $520 looks like it's certainly not going to come in, so Jack Kent, we're writing it off. $520 allowance for doubtful accounts was debited, and the accounts receivable for Jack Kent was credited. So you can see, if we look at, I'll just look at the right here, our allowance for doubtful accounts first. It had a debit balance in it of $1,500 to start off with. The $520 was credited, and that drew the account balance down to $980. So the balance after this happens was $980 in the allowance for doubtful accounts. We'll also look at Jack Kent's receivable specifically. It was $520, and then it was reduced by $520, so his receivable specifically is $0 now. And if we look at our general ledger accounts receivable, well, the balance in it was, say, $20,000. We wrote off Jack Kent's for $520, so now the balance is actually reduced to $19,480. The strength of the method where you actually first estimate what your bad debt is going to be and then actually write off the bad debt as you go along is that it gives a fair representation of the estimated realizable value of the accounts receivable. You know, if we look at here, for example, the accounts receivable before the write-off, which was December 31st, it was $20,000, and we put in this less $1,500 for doubtful accounts. So we estimated our doubtful accounts to be $1,500. So the true net realizable value of the accounts receivable was $18,500. After in the next period, when we actually did a write-off for $980, you'll notice that the actual realizable value of the accounts receivable matches that at $18,500. So this gives a stronger representation of the reality of what our true accounts receivable is. You might ask too, what if we recover the debt? So we wrote off the debt for Jack Kent, $520. Let's assume Jack walks through the door one day with $520 and says, "Oh, I have your money." And we think to ourselves, well, we wrote it off. What do we have to do? Well, what we need to do is, first of all, make a journal entry to reset up the accounts receivable. So accounts receivable for Jack Kent would be debited for $520, and the allowance for doubtful accounts that we had drawn down on would get credited for $520. And the fact that he actually paid the cash needs to get reflected, and the cash will be debited by $520, and the accounts receivable for Jack Kent will be credited for $520. So effectively, he paid his bill. So we estimated an allowance for doubtful accounts, $1,500 for this particular example. Where do we get that number to? Well, whenever we estimate allowance for doubtful accounts, we need to be able to come up with some method in order to estimate that. And generally, there are three methods. First, there's something called the accounts receivable approach, which looks at our accounts receivable and makes a estimation in terms of percentage of how much of it will be recoverable. Then there is something called the aging of receivables approach, and that works on the philosophy that the longer a bill is outstanding, the less likely it's going to get paid. So we'll look at the detail of that in a minute. And the percentage of sales approach is a third method that can be used, and we'll look at that. So now let's look at each one of these in detail. First, the percentage of accounts receivable approach. What this method does is it assumes that a certain percentage of your accounts receivable will be uncollectible. A small percentage, hopefully, but a percentage nonetheless. And how we estimate it is very simple. We take our year-end value of accounts receivable and we apply an estimated percentage of bad debt. Now, where do you get the estimated percentage of bad debt? Well, usually there are industry figures, but also from our own personal experience, if our business has been around several years, we're going to know, let's say, that 1%, 2% of our total accounts receivable will be uncollectible. That's where we generate that number, experience or the experience of other companies. So what we need to be able to do is to figure out how to actually do the mechanics of this percentage of accounts receivable method. And it's pretty straightforward. You got this allowance for doubtful accounts. It's going to have a balance in it. And then we're going to figure out, well, what is the estimate for this year that we're in? Okay? And we're going to add to that balance the estimate for this year. So the estimated adjusted balance in allowance for doubtful accounts plus or minus the adjusted year-end balance in allowance for doubtful accounts will equal the estimated bad debt expense for the year. The objective for the entry is to make the allowance account balance equal the portion of outstanding accounts receivable estimated to be uncollectible. The next and a little more complicated approach is the aging of accounts receivable. And as the name implies, it looks at how old the accounts receivable is, and as it gets older, a greater percentage, the theory is, as it gets older, a greater percentage of that old accounts receivable will never come in. So what we need to be able to do in order to make this happen is we have to group accounts based on how much time has passed since they've been created. And then we're going to estimate rates of uncollectability for each group. And we're going to apply a rate to each group and get the required balance for allowance account. Now, that sounds more complicated than it is. Here's an example. So how do we actually age accounts? Let's take a look at an example. Here's decor. We've looked at, we're into our books on December 31st, and we're looking at our receivables from specific companies. So let's just take a look at decor, for example. Decor owes us money. In fact, they owe us $49,900. So that's the total accounts receivable from Decor. And what we do is we can break down that amount into subcategories of how old it is, depending on how old it is. So 37,000 of that is current, meaning that it's really just now they went and bought it. It hasn't been outstanding very long at all. 6,500 of it is between 1 and 30 days old. 3,500 of it is between 31 and 60 days old. And 1,900 of it is between 61 and 90 days old. And over 90, there's $1,000 owing that is over 90 days old. So we see the various age of the accounts. Now the theory says that, okay, as the account gets older, in other words, it hasn't been paid yet, the probability of it not being paid is going to go up. So here we just have some estimates of bad debt. And again, this information comes from experience or other companies or industry standards. So current debt, 2% of it will not be collectible, estimated. 1 to 30 days, 5% is estimated not to be collectible. 31 to 60 days, 10% of it is not estimated not to be collectible. 25% will not be collectible if it's 61 to 90 days. And over 90 days, then we estimate that 40% of it will not be collected. If we prorate each of those, in other words, 37,000 times 2%, 6,500 times 5%, 3,500 times 10%, and so on, we can get an estimate for the uncollectible amount. So, in fact, doing the calculation on Decor, we estimate that $2,290 will not be collectible. We could do that with every one of our accounts using a simple spreadsheet and be able to come up with an estimate for our total potential this is not certain, potential money that will never come in. So that will help us allow for doubtful accounts. So effectively, we set up the allowance for doubtful accounts at the end of the year by looking at our year past and estimating the amount of debt that we would think is going to go bad. So let's assume in year one we estimated that $1,500 would go bad. So during the year we sold stuff on credit. Most of the money came in, some of it went bad. We wrote it off accordingly, and the debit balance now exists in the allowance for doubtful accounts of $200. We're estimating that we need $2,290 in that account. So, and that would be a credit balance in that account. So there's a debit balance in it now of $200. We need to make it a $2,290 credit balance. So the difference between the two, or the adjustment, would have to be $2,490. So we would do that by simply writing bad debt expense for $2,490 debit and crediting the allowance for doubtful accounts for $2,490. That will be done at year end. And effectively what that does is it sets up a pool for estimated bad debt into the year ahead. Next we have the percentage of sales approach, and it really uses income statement relationships to estimate bad debts. So effectively what we do here is we take the current period sales and we come up with a percentage estimate of bad debt, say 0.2%, 1%, and we just simply multiply the two in order to get an estimate. All the other mechanics is the same as what we've done previously. The final method is the direct write-off approach. This method sometimes is used as an alternate to the others, and really it's only used when the amounts are really not very much or not material. So the loss from an uncollectible account in this case is simply recorded when it's determined to be uncollectible, and this method really doesn't satisfy GAAP, but it does work if the debt is written off in the year that it occurred. So here's a simple example that a specific customer's account, say for example Jack Kent, is considered uncollectible. So we recognize that, well, he's not going to pay the bill. In order to do this, the direct entry is very simple. Bad debt expense is debited for the amount, $520 in this particular case, and the accounts receivable is reduced or credited by $520. A straightforward write-off. In part 2, we're looking at notes receivable. Well, note receivable is really a short-term loan that the company loans to someone. They tend to be in the form of either promissory notes, and a promissory note really is a written IOU, promise to pay a specified amount of money either on demand or a defined future date. So let's say, for example, you'll owe me money today. Promissory note would say I owe it back in 30 days. That would be an example of a promissory note. Promissory notes are also a form of short-term notes receivable, which is a promissory note that becomes due within the next 12 months or within business's operating cycle, which is normally 12 months. So as I say, these notes are normally interest-bearing, and here's how you simply calculate the interest. You take the principal, you'll multiply it by the rate of interest, multiplied by the time. Usually it's a proportion of a year. Say, for example, 6/12 is representing 6/12 of a year or 6 months. It could be easily 180 days of 365, 30 days of 365, 1 month of 12, that sort of thing. So, in this particular example, we have a principal or an outstanding amount of $1,000. It's 6% interest, and it's for 6 months. So we take 1,000, multiply by 6%, multiply by 6/12, and that will give you an amount of interest of $30. Journalize this transaction. What we need to do is say, for example, that on July 10th, Techcom receives $1,000, 90-day, 6% promissory note at the time of sale. And the simple entry is notes receivable debit, $1,000, sales, $1,000. So someone actually is guaranteeing that they're going to pay $1,000. So hence, notes receivable. Then, next, we have toll repayment come back. So on October 8th, Techcom receives payment for the $1,000 plus the interest. So in this particular case, $1,015 would come in total, and that would be debit cash, $1,015. On the credit side, notes receivable would be for $1,000, and the interest income for $15. So next, let's take a look at it when some money comes in. So let's take this example here. On December 16th, Techcom receives $3,000, 60-day, 6% promissory note, and $1,000 cash to settle a $4,000 past due account. So someone owes them money, and they're going to convert that accounts receivable to a notes receivable. So effectively, we have $1,000 coming in, so that's debit cash, $1,000. We're going to debit notes receivable for $3,000, which is the amount of the promissory note, and we're going to credit accounts receivable for $4,000 to represent the payment. So that note was made in the middle of December. In the previous example, let's assume now our year-end comes up on December 31st. We need to record the fact on our books that there is some interest receivable, and we'll calculate that to be 15 days worth of interest on that would come to $7.40. So we'll make an entry that records interest receivable debit for $7.40 and interest revenue credit for $7.40. And that would represent how much money is owed to us in terms of interest, or how much we've accumulated. Now, let's assume that in February, the 60-day note matures. And what happens then? Well, the cash comes in. Let's assume that it gets paid. Everything is honored. So cash in total will be $3,029.59. Where did that come from? Well, we're going to credit interest revenue for $22.19, which is the this year's amount of interest. The interest receivable was from the tail end of the previous year, $7.40. That's debited. And we're going to credit notes receivable for $3,000. Finally, like in accounts receivable, some people just do not honor or do not pay their bills. So sometimes the maker of the note simply doesn't pay, and this is known as dishonoring the note. And the payee should use every legitimate means possible to get that money, so a collection agency and the like. And the note receivable and uncollected interest is charged to an accounts receivable in the name of the maker of the note. So it would, again, work in terms of the matching principle because we have set up an allowance for doubtful accounts.